Welcome back to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan. Today we're diving into a topic that's been on everyone's mind. Have Canada's new mortgage rules changed the outlook for buyers? With a flurry of measures announced recently, we're here to unpack what these changes might mean for home buyers and the real estate market at large. The Canadian federal government has introduced several significant changes in the housing and mortgage sectors. Among the most notable are expanded access to 30-year amortizations, a higher insured mortgage cap, and the removal of stress testing for uninsured mortgage holders who switch lenders at renewal time. But the big question remains: have these changes improved the outlook for homeowners and those hoping to buy? While these measures aim to ease affordability challenges, it's important for brokers and their clients not to see them as a complete game changer for every potential homebuyer. According to J.P. Boutros, a mortgage brokering sector advisor and member of the Financial Services Regulatory Authority of Ontario's Mortgage Brokering Strategic Advisory Committee, first-time buyers need to remain clear-sighted about their motivations for purchasing a home. Boutros points out that with the rising costs of home ownership, like land transfer taxes and development charges, the financial benefits of owning a home only start to become apparent after 8 to 10 years. For those considering buying, he advises that the primary intention should be to find a home they can live in and love, rather than treating it as a short-term investment or a fear of missing out purchase. One of the most talked about changes is the increase in the insured mortgage cap to $1.5 million, a move that surprised many in the industry. While some had long advocated for raising the cap, critics argue that this could lead to increased competition and potentially higher debt levels for Canadians. The Greater Toronto Area, in particular, may see intensified bidding on high-priced properties. The return to 30-year insured mortgage amortizations has been a topic of speculation since 2019. Boutros critiques the delay in implementing these changes, suggesting they should have been introduced years ago for greater benefit. He believes that we're essentially restarting the conditions of 2018 and 2019, and it'll take a few years to see the full impact. For single Canadians, especially those wanting to live in city centers, the heavy costs associated with mortgages, condo fees, and other expenses may not be appealing right now. Boutros emphasizes the importance of doing the math to decide if renting or buying is the more sensible option. This could potentially skew the market towards investors who might buy properties to rent them out, allowing someone else to cover the mortgage costs. Another significant change is the removal of the stress test requirement when switching lenders at renewal. Boutros welcomes this decision, describing the previous policy as anti-competitive and anti-consumer. He criticized the delay in enacting this change, which he argues prolonged the frustration for many Canadians looking to switch to cheaper lenders. Looking forward, Boutros suggests there are still numerous changes the government could consider to improve housing affordability and availability. He highlights development charges as a major barrier to construction and stresses the need for discussions on how to fund cities properly, potentially through municipal or regional taxes. Let's turn our attention to the staggering combined value of Ontario's real estate, now estimated at an impressive $314 trillion. This figure, reported by the Municipal Property Assessment Corporation, marks a significant increase from the previous year's tally, rising by $42 billion. This growth underscores the robust nature of Ontario's real estate market, even amidst the various challenges it faces. In particular, Toronto's property values have shown remarkable strength, with a jump to $9.93 billion. This increase is reflective of ongoing development and investment in the area, highlighting Toronto's appeal as a prime location for both residential and commercial real estate. The city's dynamic market is a key contributor to the overall valuation of Ontario's real estate portfolio. The rise in property values can be attributed to new construction projects across the province, such as those at sites like 407 Dundas Street West in Oakville. These developments not only add to the housing supply, but also enhance the economic landscape by attracting businesses and residents alike. It's important to note that this valuation is not just a reflection of residential properties, but also encompasses commercial and industrial real estate. The diverse nature of Ontario's real estate assets plays a crucial role in its economic stability and growth. As we look at these figures, it's clear that Ontario's real estate market remains a vital part of the province's economy. With continued investments and developments, the market is likely to sustain its upward trajectory, offering opportunities for investors, developers, and homeowners. Recent high interest rates have certainly made a significant impact on Canada's housing market, particularly on new housing starts. According to a new bulletin from the Canada Mortgage and Housing Corporation, or CMHC, these higher interest rates have led to a reduction in new home construction by approximately 30,000 units in 2023. This represents a decrease of about 10% to 15% from the annual average of 250,000 units that we might otherwise expect. It's important to understand that housing starts are a key indicator of the health of the real estate market. They mark the commencement of construction work on a building. So, a drop of this magnitude is significant as it mirrors the total number of housing starts within Metro Vancouver for the same year. This is a clear sign of the challenges the market is facing due to high borrowing costs and decreased demand for home ownership. The high interest rates have not only dampened the desire for home ownership, but have also increased the costs associated with financing land acquisitions and construction. In response to these market challenges, various provincial and federal governments have stepped in. They're offering significant repayable, low-cost construction financing to private developers, focusing on secured purpose-built rental housing projects. Some of these projects have even been converted from strata market ownership condominiums to secured purpose-built rentals. Interestingly, unsecured market rental housing, particularly those condominiums rented out by individual owners, remains a significant portion of the overall rental supply, especially in urban areas like Metro Vancouver and Greater Toronto. However, with condominium projects stalling, this source of new rental housing supply has stagnated, leaving a gap in the market. CMHC has also highlighted that the full impact of high interest rates on Greater Toronto's housing market might not yet be fully evident. Private developers often proceed with condominium projects only when around 70% of the units are pre-sold. This highlights how sensitive housing starts are to the interest rates faced by home buyers, while rental housing starts are influenced by the rates faced by corporate investors. Despite some calls for increased public housing, the private sector remains the dominant force in building new housing in Canada, accounting for 95% of the housing supply. The private sector is crucial for increasing supply and improving affordability. Small investors play a vital role in funding condo apartments, while large investors supply the necessary financing for large multi-story purpose-built rental buildings. To better meet long-term housing demand and improve affordability, CMHC recommends that all levels of government ensure the private sector is encouraged to build as much housing as possible, especially when interest rates are favorable. With the Bank of Canada expected to continue lowering its policy interest rate, this could stimulate new housing supply in the coming year. Currently, the policy interest rate is at 4.25%, following several cuts this year. Economists predict it could drop to 3.75% by the end of 2024 and 2.75% by the end of 2025, which could be a boon for the housing market. As we wrap up today's episode, let's look at the latest trends in mortgage rates across Canada. Despite the recent rise in bond yields, some provinces are still offering mortgage rates below 4%, but they might not be around for long. This is like a clearance sale, with lenders such as Connect advertising a 3.99% 5-year insured rate in provinces like Alberta, British Columbia, and Ontario. Given the economic conditions, these sub-4% rates are a rare find, and with lender profits being squeezed by rising yields, they may soon be a thing of the past. It's worth noting that the lowest advertised 5-year fixed rates among national lenders have all climbed back above the psychological 4% mark. Nevertheless, 5-year rates remain the most competitive of all fixed terms. The upcoming economic reports, particularly Canadian unemployment figures and inflation data, will likely influence these rates further. For those who prefer variable rates, there's some good news on the horizon. Markets are currently pricing in a 100% chance of the Bank of Canada decreasing its policy rate by at least 25 basis points on October 23rd. This potential cut would reduce Canada's benchmark prime rate to 6.20%, a level not seen since 2022. This development could offer some relief to financially stressed consumers. As we continue to monitor these developments, it's clear that the mortgage landscape is ever changing. With the Bank of Canada potentially easing its policy and the economic indicators playing their part, the coming months could present new opportunities for both buyers and investors. Thank you for tuning in to the Ontario Mortgage and Real Estate Insights podcast. It's been a pleasure to bring you the latest updates and insights from the world of real estate and mortgages. Be sure to join us next time for more in-depth discussions and expert analysis. Until then, take care and stay informed.